if you're a public company in this space and you're seeing the stock market go down like it has been for technology in the last year or so, you probably rue the day you went public and think back to the time when you could just sit down with a couple of investors and convince them of the brilliance of your idea and its opportunity. And if you're a private investor and you're frustrated because you can't get enough capital, you really wish you were one of those public companies who could so easily get money just by issuing stocks or bonds. Of course, the truth is somewhere in between, and we often have interesting things come into the capital markets like SPACs, which were all the rage, and we saw some of them rise tremendously and then crash in an awful way. So SPACs are not so cool anymore. But we're going to have a very good panel coming up right now to contrast the public and private ways of raising capital in today's market. And we're very honored to have Marina Bogard from Betsson, who is going to be interviewing a group of investment bankers and private investors. So if we can have the group come up.
Hear me okay? Great. Thank you. And what a time to talk about public versus private, given what the stock market's been doing over the last probably year, but certainly most recently. But before we get into that, I'd like to introduce you to these gentlemen that we have up here, starting at the very end. We have Gabe Fineberg. He's Vice President of Beach Point Capital. And we have Ramy Ibrahim, who is the Managing Director of Moelis & Company. We have Steve Tsao, General Partner of Yolo Investments, who just flew in from the Philippines, so be kind to him. Or ask him a lot of questions, since he's a bit tired today. And sitting here next to me is Catlin, Managing Partner of Discerning Capital. We won't go into the bios for the interest of time, since we're really running late here anyway. So you can find more information about them in the agenda, or feel free to talk to any one of us afterwards. So private versus public. I mean, we all know in this room how expensive being a public company can be, not only from a financial perspective, but also from a resource perspective. You know, filing quarterly reports, really kind of having that forced focus on short-term performance and financials versus long-term value. And we know some of the iGaming and sportsbook companies that are public today have just been getting hammered with their stock over the last couple years. So you could argue that it's probably not as advantageous to be a public company versus a private company in this sector. But then on the other hand, we have analysts and researchers indicating that 2023 could be the year that we have some IPOs coming out that have been anticipated for quite some time in this sector. So diverse thoughts here, and that's what we'll spend some time here talking about that. Keep in mind, this is thought-provoking, not meant to guide you in any investment strategies, so nobody's on the hook here on the panel. So Gabe, why don't we start with you? With the current market trends, is staying private more advantageous in this market?
I think it just depends on the type of company that you have and what you want to do. I think if you need a bunch more capital, you know, being public has its advantages. You can sort of more easily tap the public markets and sort of use that as a currency to fuel growth. You know, I think if you have a strategic or financial partner who, as a private company, believes in your vision and you sort of have a growth trajectory with them to fund it, that's obviously operationally a little bit easier. So candidly, I think there are a lot of puts and takes. I as an investor, it's not all that important to me one way or another if the public's, you know, if the company is public or private. I think it's pretty bespoke on what the company's trying to achieve, how much money, you know, it actually requires for the company to achieve its vision. And so to a certain extent, I think there's a real preference on weighing the pros and cons as opposed to a right way or a wrong way to do things.
Ramy, any additional thoughts from you on that?
This is a really tough topic because it absolutely depends on, and it's very case specific. Look, it's a privilege to be a public company anywhere around the world, and getting public is one thing, but being a public company is something completely different. I think size and scale is important. I think the reasons you go public and where you go public are important. For example, in Stockholm right now, if ESG pressures have put a damper on a lot of the stocks that trade there, particularly in the sector, and so you had an exodus of institutional investors that don't want to be in anything that touches sin or gaming. So location is important, but the SPAC craze created an opportunity for people to say, oh my God, here's my chance to go public without the traditional IPO path. But it's not easy. It's expensive. The scrutiny on the business is tremendous. And you are managing a business on a quarterly basis, and that can be quite challenging, particularly for small companies. So I think in this kind of environment, broadly speaking, I personally would rather be private. You've seen how long it's taken Flutter to consider going public with FanDuel, and that's a business that's doing $3 billion plus of revenue and is about to turn profit. And remember, if you are public as a small company, you're not going to have a lot of volume and float. You're not going to have a lot of research coverage, and you just don't get the benefits that many of these public companies are able to receive. Now, you do have access to capital. Generally, you'll have access to cheaper capital, but your stock is so volatile that you may end up having a down round, if you will, if you end up in an environment like this one. So there is no one size fits all, but my perspective is you better be ready for what's coming as a public co, because it is not easy and it's quite burdensome.
Yeah, and several, and I won't go into the names here, but several of these public companies have also indicated that there's really no guarantee in participants in the market really valuing appropriately this sector in the long term. And we've seen that in the stock prices with some of the big folks that are in iGaming and in sports betting today. So Ramy, you hit the one section that everyone's probably interested in, SPACs. Like, what the hell happened? It just went completely up to the sky and just crashed incredibly. Any thoughts to that? Steve?
Okay, I think in my 20s I did a reverse listing. That's really what it is. SPAC is a new word for reverse listing. It's basically you don't have the business track record to go through an IPO process. You don't have the business track record to go through a traditional underwriting to provide some, stronger hand, some liquidity or whatnot. So SPACs is the route you take. The quality of assets, I think, kind of reflects that. So I lost more in that space, kind of being a FOMO investor, rather than being kind of going through my own experiences before. So I think what's happened on it is not a surprise, and the way our team kind of looks at it today is kind of like, as Ramy said earlier, is what market, who are the partners behind it, what are their track record, and then how is the business and the communications of it going? As a private company, you don't have to do that part of the game as much. But I've done an IPO, done a reverse listing, and ran a NYSE listed company, and I'll never ever do that again. So, yeah.
Davis, what are your thoughts on that? Do you think that it'll ever come back?
There's always going to be tulip bubbles everywhere in the world where people think they can get rich, and so. But I think what we're really talking about is how to get access to capital. That's really the public, private, SPAC, whatever. It doesn't really matter. At the end of the day, the question that everyone should be asking is, how do you get access to the cheapest capital you can? And the truth for everyone in this room, whether you're public or private, is the cost of capital has gone up materially. There is, what the Fed is doing, and there is also risk aversion, or actually probably an appropriate level of risk aversion. We're not scared yet. But it does seem like we're more and more starting to see the issues that we, kind of had this concept of we planted seeds that were inappropriate 2 or 3 years ago. People raised too much money at too high of a valuation, and here we are today. I think 2 years ago, we'd be sitting up here, we'd be talking about all the deals that we're seeing that are huge up rounds, billion-dollar valuations, and here we are today saying, like, what do you do? How do we survive? And I think that's kind of, SPACs, as you can tell, I didn't love them when they were happening. I always love this. I got a phone call from someone I didn't know, said, hey, we want to put you on the board of a SPAC. I was like, well, what does that mean? Like, it means we pay you $250,000 a year. I was like, what was that? That's not an investment strategy. It just was so insane in the moment. But I think really it's about, at this point, get capital, survive, get back to when the capital markets aren't frozen.
And I think that's a great segue into the question. So for the entrepreneurs and smaller companies in the room that might be struggling to get in capital, what is the answer for them? Ramy, any thoughts?
Can I add an asterisk to the SPAC conversation real quick?
Okay,
Because
sure.
I don't want everyone to walk away thinking that you throw out the baby with the bathwater. There have been remarkably successful SPAC transactions. I share the view that I think that moment has passed, but DraftKings is one of the best SPAC stories of all time, and frankly, you could argue it helped create, what became 600 different IPOs chasing, or 600 SPACs chasing transactions. So there is a bespoke, tailored, unique situation where a SPAC is the vehicle, particularly back then at least, where you can provide the market with forward-looking numbers in an environment where nobody knew what an emerging market would ever look like. But that's very, very case specific. To answer your question, as far as entrepreneurs go, and we deal with a lot of entrepreneur-led businesses, and you've had a lot of panelists here that have invested in them. How do they raise capital? Well, I think, they've got to have a very solid business that is growing, and they've got to have governance in place with a board that is helping them think through the things that they either don't know or don't have the time to figure out. And when you have that sort of structure in place, with that sort of advice, it puts you in a much better position to go out and raise capital from folks like are here in the room or on the panel. And entrepreneur-led businesses, entrepreneurs are very unique animals. But disruption will continue to be in vogue. And even, I think one of the panelists said, even though DraftKings, FanDuel, and BetMGM control 75-80% of the market, that 25% is part of a massive market that's going to continue to grow, and there are going to be up-and-comers. I mean, every year you hear about someone that's kind of shaking things up a little bit, like Better with their microtransaction, as an example. So I think entrepreneurs need to find the right, governance in place in order for them to be successful, and raise capital where it's not so egregious that they end up having down rounds or having to hand the keys over to their shareholders.
This is a little bit outside of what we were discussing amongst the group, but given that, and given that the space is big, it's still nascent in the U.S., there's a lot of players. Is it becoming oversaturated if you're a pure sportsbook operator?
To compete in online sports betting in the United States today is incredibly competitive. I can't see a scenario where the top three today don't remain the top three, or at least be in the top five. Fanatics is coming out. Bet365 is going to start spending more money. There's a long list of people that could touch that, but it's tough to see FanDuel, not keep that leadership position. Having said that, is it saturated? No, but I think what the first wave of what people did in the space is they were feeding off of what investors were cheering. They were cheering TAM, they were cheering market share, they were cheering revenue growth. That's why DraftKings went to $70 a share. And then it became, well, when are you actually going to turn a profit? And it all flipped, and it all fell. And I think now they're focused on profitability versus growth. But is there room for others? Absolutely, particularly when iGaming comes on. That will be the game changer, because the payback on an iGaming customer is a fraction of what it is on sports, and the margins are incredibly more attractive.
And I agree. I know in one of the other panel discussions, there was conversation sportsbook versus iGaming and what's going to take the lead. And from what I've seen in the industry for over a decade, it is iGaming will surpass the revenues associated with sportsbook. So kind of segueing into that, Gabe, companies like MGM and Caesars who also have land-based assets, is that more of an advantageous investment risk versus a pure iGaming or sportsbook company?
That's a loaded question. I think over time where we're going to see things going is there's going to be an omni-channel. There's an omni-channel in name your industry that got disrupted by the internet. Things are not I mean, even retail, right? That people pan. There's Amazon, but Walmart is still fantastically competitive. I don't see any reason why gambling should be any different. There are going to be people who prefer land, and there are going to be people who prefer online. I think where we as investors, or at least in my seat, my overall thesis on the digital side is trying to figure out, who has a little bit of an edge and what's that edge going to be. And that edge could be, TAM and being a market leader and having built a product that, your competitors are just not going to be able to economically catch up to. It could be doing things a little bit differently on the technology side. It could be being a technology provider. It could be having a different form of content. I think omnichannel is yet another manifestation of just differentiation that's going to allow for staying power for particular companies. But I think there are a lot of different ways in my seat to have staying power, all of which have the common denominator of needing a little bit of an edge or a differentiation as compared to simply going out and doing the same thing that everybody else is doing.
Hey, Steve, so with all of this conversation, if you're a small operator, do you focus, and this is always such a difficult thing to do as a company, do you focus on revenue growth and what we've been seeing with all the marketing and acquisition spend, or do you focus on now with the issue, when do you get to profitability on some of these bigger ones? For the smaller ones, it's a bit difficult. So is it cash flow neutrality or is it revenue growth?
I think it depends on what you're good at. So I kind of split everything I look at into two buckets. One is you know how to make money. The other one is you really know how to raise money. If you don't fall into either bucket, you're probably going bankrupt pretty soon. But so if you have a margin-producing business that is on path to cash flow break even, then money will be there. Money should be there. But there are people that are very good at raising money and doesn't need to achieve that. So if you have that magic halo around your head, that's an option that you have that's not available to everybody else. But I think 70, 80, 90% of the people I talk to, they don't have that halo. So you got to focus on building the business and building it in a cash flow neutral, positive direction. Otherwise, all of us as investors up here, we're going to squeeze every bit of blood out of you. And we're going to wait till, look, part of negotiations, we look at your cash flow, we look at your runway, and we might commit. And, it might be, it's not our job, because if you have money, then you're in a strong position. But if you're on a path that leads nowhere, well, we'll probably just pass anyways.
Yeah.
So Steve, you're of the radical mindset that businesses exist to make profits?
Shocking. Shocking.
Public
Speaking-
service announcement, be careful who you take your money from.
So with that segue, David, you guys are pretty good with the segues. We haven't even rehearsed any of this. So all the big four are indicating profitability in 23. It was 22, now it's 23. I think some are kind of pushing maybe early 24, guiding the market. If they continue on messaging that, do you see a resurgence in their stock prices this year?
I think, we've kind of reached the show me phase of capital markets. So to Steve's point, I think it's a really good one, is if you have a plan that makes sense, it's rational, and you can sit down to investors, whether it's public or private, and say, this is our plan, this is how we intend to do this and execute, and here's our strategy, and here's the cash flows and incremental margins, all these things. Doesn't matter if you're public or private, you're going to have success.
Right.
Now, the question is 2 years ago, people, probably us, would underwrite deals to 3 years to break even. I think now it's sort of, okay, you need to be 12 months away from break even. So our capital that we can give you can get you to scale. So my gut, and before I did venture capital and gambling, I used to work for a $75 billion asset manager doing gambling investments. So I can say pretty confidently that if they get to profitable growth in the U.S., and I like to joke that when they say they're getting profitable, let's just be clear what they're saying. They're talking about adjusted EBITDA. I like to joke, I'm like, can you pay your mortgage with adjusted EBITDA? I'm not sure how that works if you can add it back. But when they reach real cash flow growth and it's positive and the margins are going up, that's when, I don't know when that happens, but I can guarantee you by that point, you will be rewarded as an investor. So the question is, does that come through this year, next year? My gut is that adjusted EBITDA, kind of fairy tale that they're selling buys them time, but ultimately, the adjustments for giving away, I don't even know the numbers. I think it was like DraftKings, like 500 million, something like that in stock-based comp last year. Pretty big number to just add back. I don't know, I still value 500 million, I guess, but so call me old school.
Can I
Yeah,
add
of
something?
course.
I think when a company goes public, whether it's IPO or SPAC, a big factor is for two major stakeholders. One is the investors, and the other one are the management. So the motivations and the triggers associated with that is also very important to look at in terms of the performance incrementally afterwards as well, if that makes sense.
Can I provide a perspective on this question of what's going to turn the share prices? I do think that this is going to be a watershed moment year. Whoever gets there first, and it'll likely be FanDuel, will do a few things, and particularly if they go public. When you start to see these stocks, I think, rebound, if you want to call it that, is when the market finally understands how to model these businesses out. And they haven't been able to do that. Analysts haven't been able to do that. Investors haven't been able to do that. The management teams themselves. It's a tough thing to model. Is California on or off? Is New York 51% or 25%? Is Florida going to be the Seminole only, or is it going to be an open market? When's Texas going to go live? Impossible. So the closer that the market is able to get to accuracy or some level of trajectory, then you can start to underwrite these deals. And when you do so, that's when you're going to start to see, in my opinion at least, massive value creation, because this market is embedded in it is massive growth. I don't know when California's going to come on, but I can guarantee you it's one of the biggest economies in the world, and they love sports. That's one example. So I think the market hasn't gotten there yet. They're getting better at that. The one thing that they did understand is you're many years away from profitability. Once they realize that, stocks collapsed. But I think we're in an environment right now where they are going to turn the corner, and it will be easier, not perfect, to start modeling these out. And that's what you're underwriting as an investor.
So if that does happen and we see that trajectory, Gabe, do you think the smaller companies have better access at that point to more capital?
I think sort of over, not to get too philosophical, but there are points in time like now where markets want to flee to higher quality assets, and there's yield and return embedded in things that you don't have to use your imagination to basically make a return. In environments in which honestly funding costs are low and yield and return are scarce, people will then gravitate down market, sometimes picking winners, sometimes stretching way beyond their wildest expectations of what they think they're investing in. So I think access to capital for the smaller, less established players, that happens when the capital available for the more established players is, you're just kind of soaked in that. Right. And then you have investors who are kind of playing down and kind of looking for more bespoke opportunities.
Yeah. I know we're kind of running down on time, but one of the questions for Ramy, since you've lived in London, you lived in Europe, you've been around, our partners who have been in this business a really, really long time, for decades in the UK and those markets. What can we learn from them?
Well, you can learn that you can make a ton of money in online gaming, right? They've been profitable for a very long time, and they've done it well. They're best in class, no question about that. So that gives hope for the American market, the U.S. market. So that's number one. Number two is if you swing the pendulum too far, then you're going to force governments to come after you, KYC, AML, and advertising. So I think one of the biggest threats in my mind for the U.S. market is if they were to be an advertising ban of sorts on a state-by-state basis. Responsible gaming, all of those things. So I think that the UK and Europe broadly, hopefully the takeaways are, if you do it right, you can be profitable. If you do it responsibly, you can stay in the game for a very long time, and don't get piggish. Don't overdo it. Yeah. Don't blast 34 commercials during the Super Bowl. because at some point, people are going to get upset.
I think what we're talking about, just real quick, is I know we're out of time effectively, but is about building sustainability, whether it's in the capital markets, keeping it rational, whether it's in how we advertise, and whether it's about giving. I just saw a business yesterday. It gives loans to players so that they can bet more. Gosh, I mean, doesn't that feel like feels like a way that we end up like the UK did, where you have bet limits come in and it nukes profitably. So I think everyone in this room has a responsibility to say, how do I not maximize for the short term? How do we maximize the next decade? And I think if we all can do that, we're going to be much better off.
I agree. And I think that's a really good way to end the panel discussion. Do we have time for a question? Okay, sorry. They're pulling me off. Thank you, everybody, for your time, and thank you for our panel members.